table of contents: learning outcomes, introduction, financial planning, that is the concept, objectives of financial planning, importance of financial planning, financial forecasting, capital acquisition, asset management, in which we will look at physical asset management, cash management, inventory management, receivable management, and then we will summarize the whole chapter. Now, let us look at the learning outcomes. In this module, you shall be able to 1. Understand the term financial planning, 2. Learn the objectives and importance of financial planning, 3. Understand the term financial forecasting and analyze its advantages, 4. Learn about the various sources of capital acquisition, and lastly, understand the concept of asset management. Finance is the foundation on which all economic activities depend. It is the lifeblood of a business enterprise and the key factor on which the success of a business venture depends. Using financial planning to chart a path and plan for the future events of the business enables the venture to be successful in the long run. Now, what is financial planning? Let us try to clear the concept. Financial planning can be defined as the task of drafting a plan through which the business venture will be able to achieve the objectives that they have set. It is the process through which a business organization is able to estimate the capital required by it both in the short run and the long run, and determine the ways and means through which the capital can be raised. It includes laying down financial policies with regard to investment, procurement, and administration of the funds that a business venture has. Sailing is a good metaphor that can be used to describe financial planning. The wind itself is uncontrollable, but the sailor can decide the direction and then adjust the sails of the boat accordingly. By tracking back and forth with the wind, the sailor stays flexible and poised to take advantage of each new situation while staying on course to achieve the goal. Similarly, business organizations need to be prepared for unexpected occurrences in the ever-changing business environment. The entrepreneurs need to be focused on the end objective that they want to achieve and take financial decisions accordingly, as these decisions have a direct impact on the direction of the business and inevitably on its success. Financial planning includes the following steps. 1. Determining the capital structure which is based on the long-term plans of the business. 2. Forecasting the quantum of finance, that is, the amount needed for implementing the business plans. 3. Determining the pattern of financing and the policies to be persuaded for implementing the proposed pattern of financing. Now, what are the objectives of financial planning? These are 1. Determining the capital required. Business organizations need to estimate the capital that they will need for short-term as well as long-term purposes. For this, the business organization needs to analyze the factors such as current and fixed assets, long-range plans, promotional expenses, etc. 2. Determining the capital structure. That is, capital structure refers to the different types of securities that will help in the composition of capital and help the business organization finance its operations and growth. The business organization will be required to take into consideration its borrowing capacity, the rate of interest, and the debt equity ratio. 3. Framing financial policies. The business organization needs to frame policies related to cash control, borrowing, lending, etc. 4th, generate maximum returns. Through proper financial planning, the business organization aims to utilize the available monetary resources in the best possible manner so that they are able to generate maximum returns on the investment. Now, what's the importance of financial planning? Financial planning is important for business organizations because of various reasons. For example, financial planning helps in ensuring adequate funds. 2. Financial planning helps in maintaining stability by ensuring a reasonable balance between inflow and outflow of funds. 3. Financial planning helps the business ventures chalk out their growth and expansion plans which help in the long run survival of the business. 4th, financial planning reduces uncertainties by ensuring sufficient funds are available to meet the changing market trends. And 5thly, financial planning helps in maintaining financial stability and profitability in a business concern. Now, what is financial forecasting? Many business organizations fail due to lack of planning and control of cash resources. However, good financial forecasting helps reduce business risk. A financial forecast is a systematic projection of expected actions of management in financial terms, that is, financial statements, budgets, and like. It is much like a map which helps in planning a road trip. A financial forecast helps a business venture achieve their goals. It is a tool that lets a business use their financial resources where they are most needed. Financial forecasts serve as working plans and are formulated for a specific period of time. It is an estimation of the future financial outcomes of a business venture and requires use of past data, financial ratios, cash flow statements, and projected financial statements. Now let's look at the advantages of financial forecasting. Financial forecasting exhibits the financial viability of a new business venture. It helps a business organization develop a model of how the venture will perform financially if certain plans and strategies are carried out or some events occur. 2. Financial forecasting helps a business compare their actual financial performance with the financial plans that they have made and then make adjustments where necessary. 3. It enables businesses to guide their business in the right direction and control the movement of cash. 4. Financial forecasting helps in setting a benchmark against which future performance can be measured. 5th, financial forecasting helps in keeping the business out of probable financial trouble by identifying potential cash shortfalls and risks. 6th, financial forecasting enables the business to estimate its future financial needs. It helps the venture to know whether they will have to raise additional capital or whether borrowing will be necessary. Lastly, financial forecasting shows the financial feasibility of the venture, thereby assisting business ventures in securing funding from venture capitalists or taking a loan from the banks. Now, what is capital acquisition? Business organizations need finance to buy new assets, finance new projects, and enter new markets for diversification and growth and to meet the daily needs of business. There are various sources that are available to an organization through which it can acquire capital. These sources are: 1. Personal savings. The easiest and the least expensive medium to raise startup money for an entrepreneur is his own pocket. The sooner the entrepreneur takes outside money, the more ownership he will have to surrender. Moreover, investors and lenders expect entrepreneurs to put his own money in the business venture. Second, family members and friends. Only a few entrepreneurs have sufficient resources to raise the funds required to start the venture. After they have utilized their personal savings, the entrepreneurs look at family members and friends who might be willing to invest in a business venture. Investments from friends and family are the most effective way of raising seed capital for the venture, as the business owner can borrow the money at a substantially lower rate or sometimes even interest-free. Also, these investors are less interfering in the working of the business. The business owners, however, should honestly present the investment opportunity and the nature and the amount of risk involved. Third, business angles. Business angels are high net worth, non-institutional private equity investors, often entrepreneurs themselves who have the desire and sufficient high net worth to enable them to invest part of their assets in high risk, high return entrepreneurial ventures in return for a share of voting, income, and ultimately capital gain. These investors normally invest in the early stage of venture when the promoters have exhausted their personal savings and sources of funding from family and friends, thus filling the gap in startup financing between family and friends and formal venture capitalists. Angel investors invest their knowledge, skill set, and contacts along with the money for the venture. The fourth source is venture capital. Now, venture capital companies are private for-profit organizations that assemble pool of money and then use it to purchase equity of businesses they believe have high growth and high profit potential. They act as intermediaries as they pool money from a number of investors and then make equity investments in portfolio companies. They mostly invest in companies that are in early stages of development or in rapid growth stage. Also, they do not make a single investment in a business venture, rather they invest in a venture over time in several stages. The screening process by which the venture capitalists decide on the venture to be financed is quite rigorous and involves a number of steps. They invest in less than 1% of the applications that they receive. The other option is going public. Through an initial public offering, which is often called IPO, the business venture raises capital by selling the shares of the company for the first time to the general public. This is the most effective method of raising large amount of funds, especially when all the other methods of raising capital have been exhausted. However, it is an expensive and time-consuming process which requires compilation with a number of regulations. Coming out with a public issue gives a boost to the net worth of the business venture and expands the equity base of the venture. It enhances the financial strength of the venture, making it easier for the business to attract more capital in the future, whether in the form of equity or debt. However, when the entrepreneurs go public, they dilute their ownership in the venture. Though they retain majority stake in the business, but going public increases the probability of an unfriendly takeover. The entrepreneur cannot take major decisions without the consent of the stakeholders. Also, important information that was privately held by the entrepreneurs can no longer be held privately and are available for public scrutiny. Loss of control and loss of privacy are the two biggest disadvantages of going public. Another alternative is taking commercial loans. They are the traditional types of loans provided by commercial banks, normally to finance specific expenditures of businesses, such as to purchase a particular machine or equipment. These loans are repaid within 3 to 6 months in lump sum. Commercial loans could be secured as well as unsecured. Secured loans give the banker security in case of default on the part of business, but they are difficult to administer. Unsecured loan is provided only to those businesses that prove their financial strength to the banks. Other lines of credit. It is a form of credit extended by banks to credit-worthy businesses, through which businesses have access to funds at their discretion quickly and conveniently. The banks provide loan with a predetermined ceiling that helps in solving the liquidity problem and that is often faced by the entrepreneurs. The entrepreneur can borrow money up to a preset limit by writing him a loan anytime during the year to meet the shortage in the cash flows. The interest is charged only on the money that is actually withdrawn and not on the limit that has been set. However, businesses need to pay a small handling fee along with interest, which is normally around 1 to 2% of the maximum amount of credit. Now let's look at the asset management. Assets refer to any item, thing or entity that has potential or actual value to an organization. They can be tangible such as building, plant and machinery, as well as intangible such as intellectual property and goodwill. Asset management can be defined as a process through which an organization is able to monitor and maintain the assets of a business venture. It refers to the systematic process through which a business is able to deploy, maintain, operate, upgrade and dispose of assets in a cost-effective manner. It is concerned with maintaining a balance between the costs, opportunities and risks in such a manner that the business is able to achieve the desired objectives. Now, what is physical asset management? Physical assets can be defined as any item of economic value owned by a corporation such as buildings, plant and machinery, etc. These assets can be represented on the balance sheet of a business organization. The condition of these assets deteriorates with time and use. Physical asset management can be defined as a systematic process of maintaining, upgrading and operating the physical assets of a business venture. It is the process through which an organization is able to examine the need and performance of assets during different stages of its life cycle, right from conception of the need of the assets to its disposal, and also includes managing any potential post-disposal liabilities. Physical asset management is an approach through which the business is able to get the best out of the assets that they own for the benefit of the organization as well as the stakeholders. What are the objectives of physical asset management? 1. Minimize the total cost of operating the assets. 2. Optimize the value that a business can derive from an asset. And thirdly, guide more funds towards assets that have a higher probability of delivering high payoffs. Now, what is cash management? Cash, like the bloodstream in the human body, gives vitality and strength to business enterprises. Though the percentage of cash in the total current assets of the business is very small, it is both the beginning and the end of the working capital cycle. Steady circulation of cash is necessary to keep the business going. Non-availability of a steady flow can hamper the smooth flow of business operations and can lead to insolvency. Cash management is concerned with the management of cash and bank balance and the short-term deposits. Its objective is to ensure right amount of cash that is available at right time, at the right place and at the right cost. It can be defined as the ability of management in identifying the problems related to cash which may arise in the near future and coming out with solutions to deal with such problems. Cash management also provides solution to the dilemma of liquidity versus profitability by assisting management in establishing equilibrium between the two. Cash itself is not capable of generating income. However, it serves as a prime requirement for income generating sources. Therefore, a business venture should keep the minimum possible balance of cash which is adequate to meet business obligations and maintain the solvency of the business. What are the objectives of cash management? 1. Minimize unproductive cash balance. 2. Invest excess cash advantageously. 3. Make arrangements for meeting planned and unexpected demands of cash. Then comes inventory management. Now, inventory management can be defined as a stockpile of production a firm is offering for sale and the components that make up the production. It includes all the tangible property held by a venture for sale in the ordinary course of business. They can be classified as finished goods. It refers to goods that are being produced and processed by the venture or is being purchased by the venture. In other words, they are the goods that are ready for sale to the final customers. The need for finished goods arises because of the need to meet the need of customers promptly. If sufficient inventory is not maintained by the business organization, it is at the risk of losing sales as the customers might turn to the competitor's product. 2. Work in progress. It refers to the partially produced goods. They are the raw materials that are engaged in various stages of production. For different units, the degree of completion may vary. The value of work in progress includes the cost of raw material, direct wages, overhead and expenses already incurred. The length of the production cycle determines the value and quantity of work in progress. 3rd, raw material. It refers to the material which is used in the production process. It is essential for a business organization to hold inventory of raw material so that the product process is not interrupted due to shortage of material. The quantity of raw material to be maintained depends on the speed at which raw material can be ordered and the uncertainty in the supply. Inventory occupies a strategic position in the asset structure of a business venture. It takes the largest share in the current assets of a business. Inventory management is a process of controlling and overseeing the use of raw material and other components that a business organization will use in the production of finished goods and managing the amount of finished goods for sale. Maintenance of inventory leads to blockage of funds. The business venture needs to take appropriate steps to minimize the stock of input and output by proper forecasting and planning. Mismanagement of inventory can lead to significant financial problems, whether the mismanagement leads to inventory shortage or inventory surplus. The objectives of inventory management are: 1. To ensure that the investment in inventory is at optimum level. 2. Ensure that production and sales take place smoothly. And lastly, avoid situations of inventory shortage and surplus. Now, what are receivable management? All firms, by their very nature, are involved in selling either goods or services. Although some of these sales will be for cash, a large portion will involve credit. When firms sell on credit, it leads to an increase in the receivables. Receivables refer to the claim that a business organization has against its customers that is expected to be realized in the near future. In other words, it refers to the credit allowed to the customers and thereby allowing them to delay the payment. Receivable constitutes approximately 25% of a venture's assets, and thus effective management of it is very important. Every business has a set of credit policies and terms under which they sell their goods on credit. Each of these policies has costs and benefits associated with it. Receivable management is the process through which a business weighs the costs and benefits attached with the credit policies. It aims to match the cost of increasing sales with the benefits arising out of increased sales, with the objective of maximizing the return on investment of the business organization. Receivable management covers areas like credit analysis, terms of credit, credit collection, monitoring of receivables and financing of receivables. The objectives of receivable management are: 1. Optimizing the amount of sales, and 2. Minimizing the cost of credit. Let us summarize what we have done in this module. Financial planning is a process through which a business organization is able to estimate the capital required by it both in the short run and the long run, and determine the ways and means through which the capital can be raised. The objectives of financial planning are to determine the capital required, determine the capital structure, frame financial policies, and generate maximum returns. Financial planning helps a business venture chalk out their growth and expansion plans, which help in the long run survival of the business. Financial planning reduces uncertainties by ensuring sufficient funds are available to meet the changing market trends. A financial forecast is a systematic projection of expected actions of management in financial terms, that is, financial statements, budgets, and the like. Financial forecast helps a business organization develop a model of how the venture will perform financially if certain plans and strategies are carried out or some events occur. The different sources available for capital acquisition are personal savings, friends and family, venture capitalists, angel investors, going public, commercial loan, and the line of credit. Asset management is a systematic process through which a business is able to deploy, maintain, operate, upgrade, and dispose of assets in a cost-effective manner. Physical asset management is a process through which an organization is able to examine the need and performance of assets during different stages of its life cycle, right from the conception of the need of the asset to its disposal, and also includes managing and potential post-disposal liabilities. Cash management is concerned with the management of cash and bank balance and the short-term deposits. Inventory management is a process of controlling and overseeing the use of raw material and other components that a business organization will use in the production of finished goods and managing the amount of finished goods for sale. Receivable management is a process through which a business weighs the costs and benefits attached with the credit policies.